What is up guys, Logan here again with another video today, and we're going to tackle call credit spreads today and how to trade them on Robinhood. As you guys know, one of the last videos I did was how to trade put credit spreads. So I've gotten a lot of questions about them as of recently, when to take them, what should I look for, and then also the percent chance of profit that I personally look for, and then also the market environment, right? When you should take these positions. I just want to say thank you guys for all the support on the channel as of recently. When you leave a like and subscribe and leave a comment, it helps more than you could ever imagine. And then thank you guys as well for all the streams and listeners on Spotify. I put that in the last video and you guys have been coming through. So I really appreciate all that. So make sure you leave a like on this video and let's get right into how to trade call credit spreads on Robinhood. So you guys already know, or for anybody who's in the Discord knows, that I'm already in some of my put credit spreads for the week. I'm really excited about these positions. They're doing well right now as of close, and then I'll be looking at adding some call positions this week as well. Now we have a lot of earnings coming out on Tuesday and Wednesday, so if I was to add call positions, I'd most likely add them on Thursday and also see what's on the plate for earnings on Thursday, as I want to avoid Tesla if possible and also Apple earnings if I'm going to play these calls, because those stocks can do really well after earnings. So we will see what this week brings in store for earnings as far as that goes. But let's take a look at the chain. Now if we look at SPY, if I was to sell a put credit spread, as you guys know, we'd be on the put side, but now we're gonna do a call credit spread. So we're gonna go to the calls instead of the puts. We're looking at the Friday expiration. Now I wouldn't be trading these yet, right? I trade on Thursday into Friday. We go into the calls. Let's say you wanted to enter them today anyway. I like to go to where your chance of profit is above 90% on the call side. And the reason for that is, even though we sometimes trade the put side around the 86, 85, 88% chance, we're in a bull market right now. The market has continuously been trending upward for the last 3 months, where it's held a lot of great support levels. If you do really well on the put side and you do bad on the call side, it could wipe out your gains for the week. So if we take a look at the calls right here, on entering today, I would be entering the 392 call. I might even go even higher than that, right? So I have more run room on SPY in case it does ramp up, right? Like if this wasn't an earnings week, I would be taking around 392, but with earnings, it might be best to go to the 393, 395, which is still phenomenal. So what you do for this is we would sell the 393 call, and then we would buy the higher strike price, the 395, and if you look at that, it creates a call credit spread. So this right here would be me putting up 200 in collateral. Now this is if I didn't have the put side. This would be the spread difference, but since I do the put side, as you guys can see, if I did that, review, it wouldn't cost me anything because I already have SPY spreads going for the put side, so I could create an iron condor. So let's take a stock like DIA, who right now is trading at 309.66. Now we are after hours, so the contracts aren't going to be updating at live time. But if we trade down, you guys can see I don't have any positions right now on it, no put credit spread side. So if we go to the call side for this Friday, we do sell, we're on the call side again. We scroll up, we'll look at something with a really nice chance of profit. So like right here, 91.95%. You don't expect the price to go up. If you don't think that we're gonna cross 316 on DIA by Friday, this is when you would take that position, right? So that's your, you have a 91.95% chance. So what you could do is hit select right here. You would select the 316 call, and then you would buy either the 317.50 call or the 319. Now I would personally go with this one because credit gets so small, it's really hard to find any sort of liquidity there. So it's hard to fill a contract if the volume isn't there and maybe there's no open interest on those contracts, nobody's buying or selling them. You might have a very hard time filling because credit spreads themselves are already hard to fill on Robinhood. I'll hit continue, call credit spread for 10 credit. Now if I scroll up and I click 1, I don't have the current funds necessary to execute this, so let's select a different one. But as you guys can see, this would require me to have collateral. So I'll go to January 29th, we'll select a 1 spread, so even right here, right? I would not advise you guys doing this one at all for the sake of the video. If I was to sell the 310, buy the 311, call credit spread, you would see that I would now need $100 in collateral to fulfill this. And this is because I don't already have the put side going on DIA, and I always enter my put spreads on Mondays. So you guys know that I have them in SPY right now as one of them. So if we were looking at entering just a call credit spread, you would still be required to have the collateral needed, just like on the put side. So we have the 310, 311 call, $100 collateral to make $52. Now the risk to reward is not there for me on this play. I mean, you're literally 34 cents from being in the money, which is somewhere you don't want to be. Of course, you run the risk of losing all your collateral that way. So you don't want to do that. Of course, this was just for the example, but that's the way to see it when you have to put up collateral. Now you can totally create an iron condor whenever you want. You can select as far out as you want to go. So we could even go to February 5th. And we could look at the percent chance of profits here, and we could probably get some really good credits knowing that we have this position for a longer period of time. So we could even go up to the 400 call and have a really good chance of profit, right? So we could even go to 400 to where, hey, you know, by February 5th, now we have $16 of run room, and you could say, hey, I don't think SPY is going to be 400 by February 5th, so you'll sell the 400, you could buy the 402, click review, you'd be putting up $200 in collateral, which I only have 100 in buying power right now, but 200 in collateral essentially to make $7. And on top of that, you're already rocking with a 95% chance of profit, and you could even close this early, right? Maybe you make your $7, and after you make, you know, you get credited that 7 right when you enter the position, so you can take that $7, do whatever you want with it. What you could do is, let's say it gets down to being worth 4 and you're up $3 in profit, you could then fill a debit, which would give $4 back, but you still kept that $3 profit. And this is just for an example, of course. If I was to play call spreads, I usually shoot for a little bit more money than that, of course. So this is another great way to play a bear market movement, or if the market is trending down in general throughout the week, this is a great way to play. Just like how we play the put sides, you can play it on the call sides as well. Now, if we were to look at some other positions, I also want to talk to you guys about the Theta and how this can also help you out on the call credit spread side. So if we go back to trade options, like I said, let's actually look at a closest to expiration so you guys can see how much Theta can actually help you in this situation. So let's just pick another random set to where we can sell the 387 and let's buy the 388. So as you guys can see here, this would be to make 26 credit, but if we click more in depthly on the contracts themselves, you can see right now there's about 3,500 other people who have this position. That's the open interest. The IV is super tiny right now. Chance of profit's about 78.53%. And you can see here that the Theta itself will chunk this specific contract down overnight. If the market's to open flat, we'll chunk that down $34 or 34 cents because we're in options. Delta's 26, but Theta's actually working in your favor. Theta's gonna hurt the contracts, but that's actually gonna help you out in this situation because you want these to become worthless or close to zero, so then you can take profits in between 50% and or hold them, which is what I do, into expiration and collect your full 100% as long as the runway is good enough. Now that is a riskier strategy. You can always fill it at the end of the day for $1 or 1 cent just to protect yourself going into after hours. So that's another very popular way to play this. And then a great individual stock to run call credit spreads and put credit spreads on would be Zoom. Now Zoom is very volatile. I've seen this stock move $50 in a day. I've also seen it move 20, 10, also 5. But let's say you want a 90% chance that by this Friday, Zoom wasn't gonna go above 435. You would sell the 435 call, then you would buy the 440 call, and that difference right there is about $33. Now you are putting up 500 in collateral, but that's still a really good percent gain. That's about 6.5% on that right there. $45 runway on Zoom, I think that's pretty solid. So you could take that position as well, and that's another call credit spread. Now that's the individual stocks that I would play it on, but I have seen stocks like Zoom and Amazon move $50 to $100 a day. Tesla's another one that does that. So if you're gonna play them on individual stocks, you know that the risk is there, but this is great for if, you know, Zoom has some bad news come out about them or they get downgraded by an analyst and you start to see the stock selling off or the whole market selling off in general, you could always scoop like a Zoom call credit spread. There is more risk behind it, but a 6.5% roughly percent gain on that in a week is phenomenal. I mean, that's literally an index fund over the course of a year. If we look at like the 10-year average on index funds, it's another really great strategy to build passive income. And I think it's my other favorite way to build passive income behind, of course, the put credit spread side and then dividends as well, because the call credit spread side for me is just mentally a little tricky, just doesn't feel as natural. And I think it's because I look at the market completely neutral, but we have been in a bullish market the majority of this year. So it's kind of hard for me to piece together why I would be betting against it. You know, so that's just my little take on that right there. That's gonna be it for me in this video, but I just wanted to show you guys I was messing with the DIA one last week. Had DIA put position, so I didn't have to add any collateral. I just threw $5 up, see if I could make it. I made the full amount, so it was really cool to see, and I was really happy with that position. So that's just the DIA call credit spread. But I want to thank you guys for all of the support as of lately, as it just means a ton. The channel's growing like crazy. Super happy with all the premium members. We have the big free Discord you guys can check out, talk to other awesome investors. But I really appreciate all the support, as I've already stated multiple times before. If you guys want more videos like this, leave a like on the video, and I'll continue to dive more into call credit spreads and how to execute put ones more and what I look for. I'm really excited to continue to help you guys in your trading experience, as it's something that I love to do all the time. So I hope you guys have a fantastic evening, and I will see you guys in the Discord tomorrow.